Welcome to EnergyRogue.com, the go-to source for the latest insights and analysis on the energy commodities market. Led by two industry veterans, Bill Shanahan and Brian Pieri, as they host their weekly commodity market recap. With over 55 years of combined experience in the energy sector, Bill and Brian bring a wealth of knowledge and expertise to the table. From trading and hedging to finance and optimization, they have seen it all and are here to break down the latest market trends and share their insights. So sit back, relax, and get ready to dive into the world of energy commodities with Bill and Brian on EnergyRogue.com.
Hello, folks. How you doing? Oh, man, we're repeating, Brian. What's going on with that?
We're gonna do that. Hey, everybody, listen, welcome. Thank you for coming. So thank you for joining.
Hey, listen, this is Bill and Brian with Energy Rogue. We're more than just an energy data and analytics. We bring you insight and a better understanding about the world of energy commodities, both physical and technical. So hang on. We're going to talk a little bit today about how to be successful in trading.
Yes. And listen, be sure to ask questions along the way. We're probably going to target about 30 minutes. That's going to be our target, but it's kind of a loose one. We want to go through all the material and we will answer questions. So if you have questions along the way, this is really going to be about how to create an edge in energy trading. So there are a lot of different ways that you can approach trading. And many people, including myself, often start with a vision of the technicals. We take a look at technical levels, and the market does gravitate to particular levels. Let's see, did we get to 79.44? I drew that line and we got 79.32. So all of these levels are based upon a school of thought in the trading, which is technical trading. But there's another factor, and this is the edge that we're really talking about in energy trading, and that is looking at the fundamentals, and these are often overlooked. So if you implement this simple process, it's going to be impossible to miss big moves. You're going to be able to identify when supply and demand, storage, exports, imports will drive the price. So the trading is at the intersection of when that price comes to a particular level. For example, Bill, what is natural gas going to be in the future? What price?
Oh, it'll easily be $4.32.
Okay. When?
Now that's really the question.
So that is the real question. It's at the intersection of when. So, but if you implement this simple process, it is almost impossible to miss big moves. The problem is everyone believes technicals give you everything. They do give you a lot. Many schools of thought on the technical trading side believe that technicals incorporate all the known information into the price. However, we're going to have some contrarian thought processes on that. The truth, this method helped us identify natural gas was topping in 2022 and bottoming in 2024. So this process, or it's not really a system, it's not really a process, it's about doing the work. And doing the work, taking a look at the fundamentals in combination with the technicals, because that is really the combination that will drive forward pricing. This stream is going to give you a step-by-step guide to knowing what may lie ahead. And now, Bill, why is understanding fundamentals?
You really are struggling with this stuff today, aren't you?
I am. Why is that the key to winning in energy?
Well, because we're putting the fun back into fundamentals. That's what we're doing.
Thank you, Omar. Thank you, Omar from the United Arab Emirates, putting the fun back in fundamentals.
So folks, the deal is that when you talk about technicals and technicals only, Those prices are set by moves by people who most of the time do not own any physical oil and gas. It is strictly financial traders. It's strictly people who are taking financial aspects. Most people who own the physical commodity are not trading, they're hedging. It's a different story. And traders usually work off the people who come in to hedge. They usually try to trade the other side. There's a lot of different things. But if you don't understand the fundamentals, you miss big market moves, because the
Yes.
big market moves are based on what actually has to do when people physically deliver and use the oil and gas and energy commodities. It is the one thing that helps you understand that. And so by understanding that, it's not complicated, but it is complex. And so there's multiple things that you need to look at to be able to get that. And those big market moves you can see them coming. And if you don't believe them, you'll get run over. This is usually what happens to contrarians, such as myself. From time to time, we just get run over by the fact that, what's the quote, Brian? The market can stay illogical longer than you can stay liquid.
Yep. And
And
I
so
think Buffett coined that.
I think
If it's
so.
not Buffett, let us know in the comments. And thank you for everybody watching live. So glad to see everybody live.
And so the fundamentals are what's going to support the technical moves. So I always look at the fundamentals of being the base layer, and the technicals is the waves on top, but the fundamentals the ocean.
So the fundamentals are the ocean. And during 2022, during this period, we were averaging anywhere from $6 to $9, and this is on natural gas. And we were communicating to our members and our customers that this does not make fundamental sense when you factor in the supply demand equilibrium. At the time, we had greater supply than demand, and so we were indicating that this would go down. Now we went down in a very big fashion, and then we've gone all the way down to the $1.90, I think, $1.90. And during this period, we've actually been communicating to our customers that we have bottomed out. And one of our most recent projections was that natural gas would get to $3 before the end of June, and we got to June 11th. So let's see. We got Marique. Hey Marique. Hey, hi from Poland. We've got Alberta, Canada in the chat. Looking forward. Brett, looking forward to talking with you. So feel free. There's also connections down below if you want to reach out to us and connect with us. And we're happy to talk to you. We do have customers in Alberta. So but
Brian,
fundamentals, yeah.
when I look at this and I see this going up and down based on fundamentals, it always reminds me of a saying that my dad always had. And he always says is that when your outgo exceeds your income, your upkeep becomes your downfall. And so sometimes it takes a while to think of that one through. But basically what he's saying, if you're spending more than you got, then it's not going to work out well. And so it's the same thing. If you're creating more supply than you need, it's going to have some pretty downward pressure on the price, which is what we saw here. Is when the price went up, everybody and their dog got in the gas business and started drilling wells. Supply exceeded, and now we're back down here.
Well, this pattern right here where we went up on natural gas was driven on fear. So the U.S. kind of topped out, and I'm just going to round it off at $10. At that time, Europe and Asia on LNG were $80. So natural gas from that process went from $2 all the way up to 10. And the fact of the matter was, in the United States, which is where the Henry Hub is located, and this is a proxy for US based natural gas prices, there was enough adequate supply. There wasn't really a demand issue. And so that's part of the reason that supply-demand equilibrium really comes into play. And this is why we urge, if you are in the energy trading space, there's a couple things that I would like to suggest or recommend, and that is, number one, you should look at your technicals, because depending on your time frame,
Right.
technicals will drive a lot of short-term micro movements, and technicals can drive over a long period of time. And part of the reason that we projected $3 was primarily fundamental, but it did have some technical logic in there. But if you look at the supply side of the equation, are we growing or shrinking? The demand side, are we growing or shrinking? Storage is an interesting one. I'm gonna come back to that one because Bill has a great comment there. Exports, imports, are we growing or shrinking on exports and imports?
And
Because
let's remember, 5 years ago, we weren't even talking about exports of natural gas.
right.
And so with the LNG, and LNG had a big burst, and then we flatlined for about the last 18 months, and we've got another burst coming in with some more plants coming online. But they
So
have to have a market, and LNG markets are basically 40% in Europe and 40% in Asia, and then 20% everywhere else.
So this is one of our charts, which we're going to talk about a little bit later. In 2016, we had 4 BCF a day of exports out of the United States. We're now
which was
up
which
over,
was basically all Mexico.
so we've added 10 BCF a day of exports. So now let's take a look at what supply has done during that period of time. So during that period, what did I say? 2016?
Yes.
So 2016 is where we started. Let's see. Oh, wait, I accidentally clicked on demand. There we go. Let's go to 2016. There we go. Take this off, move this back up. Look at this supply growth. We went from 73 BCF a day to over 100, and we're currently at 100. So on just the export side of the equation, we grew by 10 BCF a day on exports. Okay. And then, but we grew over 25 on supply.
But over that time, Brian, we also had the steady increase in demand that we have with natural gas based on electricity of about 2.5 to 3% a year.
Well, and you can see it when we get to our demand side, in that, let me take it back to 2016. You will see higher highs here and higher lows. And let me see if I can change my little thing to make it a little easier to see. There we go. All right. So we are setting new highs on the demand side during the winter. And I mean, this is 20 BCF a day. So when we're talking about these higher highs, I mean, that's 20 BCF a day. Now it is only in the winter. Now we need to look at the summer. We've got here, here, here. This is where we have grown to where the summertime, we are injecting less and less. And look at this. We started down around this 70 level, and now in the summer, we're all the way up to 90 something. So we've added base demand. Now let's do another exercise. Let's take off the LNG exports and look at the delta here. We've gone from here all the way up to here. So we've gone probably about 15 BCF a day.
Right.
Meanwhile, we've gone another 10 BCF a day during the winter. So that gets us awfully close to balanced,
Right.
meaning our supply and demand is not quite imbalanced, even though you could take one variable, but our supply and demand is very elastic. And that's part of the reason that you see prices. And our recent price projection was we were looking at the supply demand, but we started projecting $3 down here back in April when we were $1.64. We
Right.
started projecting $3, and it sounded crazy, but we based our decision on supply was stabilizing, that was flattening out.
Right.
Demand
Rigs
demand
will go down.
was increasing. Storage is out of balance. We're above 5-year averages by a lot. But let me tell you something. We've gone in the past month and a half from 35% over the 5-year average to 24. And this week, I expect it to contract some more. So our storage model right now for the rest of the year, if you want insight into that model, if you want to look at that model, you can come join us, and we'd be happy to share it with you on a call.
And the one thing we
Exports,
need to understand about storage while we're here is when you have demand increasing and you don't increase storage, you could actually end up with a shortfall in the high demand times, especially in the winter. So
right?
our storage has to continue to increase. So if you go back and look at the 5-year average and say, well, we want to keep it to 5-year average, well, that means you're going to be short in the current year.
Well, we just showed supply grew, what, 25 BCF since 2016?
Right.
This goes back to 2010.
No significant storage growth.
We haven't grown above that. We have shown some lower or higher lows, which actually means we're not injecting or we're not withdrawing as much in the winter, but we're not injecting as much during the summer. And that has to do with how the supply during the summer and the electric demand, as much as renewables has increased, electricity demand, let me show you this. And I know we're talking about natural gas, but it's a very easy linear example, but let me show you what's happened on electric. This. So we have, again, higher highs. We are stair stepping up and getting higher highs during the summer or during the winter, and higher highs during the summer. Look at this growth. I mean, that's gone from what, 37 to over 43. That's
I wonder if that correlates with the number of cell phones active in the U.S.
There probably is a very high correlation there. So listen,
Also,
feel free to.
and also not to forget that we do import gas from Canada as well. So there's
Well,
some balance to the exports.
and that's another aspect that we should look at. And Brett, you may know this being in Alberta, but we import. Let's see, we import in the United States roughly anywhere from 4 to 6 BCF a day, and that's been pretty flat. It has contracted over time, but Canada is building and completing Kitimat LNG, which means that's going to be about 2 BCF a day that Canada is going to have to supply, and there's two ways they can supply it. One is new drilling, which they are drilling some.
Right.
Two is they reduce our exports to the United States, which I see as likely. So there is a high likelihood that we are going to decrease on our imports from Canada at the same time that we're going to bring on over 5 BCF a day of LNG exports out of the United States.
And
when
the demand keeps growing.
Yes. So anyway, it's not market dynamics today, but you need to leverage and understand what happens on the supply side, the demand side, the storage side, exports and imports. By understanding the fundamentals of the energy market, you can gain a significant trading edge that most traders overlook. What we're going to cover, we're going to master supply dynamics, we're going to decode demand trends, understand storage insights, project market imbalances, and save some time with competitive, comprehensive insights. So on the supply side, for those energy traders that are not in the oil and gas business, if you are looking at natural gas or crude oil, you have a profile of a new well. When that well comes online, it produces at its peak rate, drops significantly over its first 12 months, and then flattens out. This is called a hyperbolic curve. And it's 12-month, that 12-month process really depends on the pressure, the downstream pressures. But this amount right here to stay flat, this needs to be filled by new production. So what we track how much we are declining. And Bill, how much are we producing now on oil?
Oil, and it's really pretty easy. We're producing about 100 million barrels a day. It's what we use globally. We produce about 13 million of that total global. That we produce about 13. Refineries right now are running really close to 16, a little over 16 million barrels a day, which means that we have a 13 million or 3 million barrel a day shortfall. But we'll talk more about how that balance works in a little bit. But so we're producing about 13 million barrels a day. So on average, a well in the first year will decline roughly 60 to 70%, which is huge. And then it begins to flatten out. And then they usually decline after they get some time on, they'll decline right around the 6 and 7% range for their life of the well.
So I want to show something, because this is something we watch every day and every week. Every month, the United States, even though we are producing 13 million barrels a day, every month we decline by 600,000 barrels a day. That means if we don't bring on any new production at all, we will be at 12.4 next month. And
in 30 days, exactly 30 days.
And exactly 30 days. And then if we don't bring on any more production, we're going to be 11.8. Then if we don't bring on any more, 11.2. So in 90 days, you could go down from 13 million barrels a day all the way to 11.2. So we start by taking a look at the decline, how much new production we are declining, which right now we are bringing on enough to stay flat. We are bringing on over 600,000 barrels a day. But that brings in the other question that we have to ask ourselves, which is, what do our rigs look like? And this is when we track rigs. So you can see this becomes a very complicated way of looking at the business. However, you should look at tools that allow you to do things like this. From 2023, we're at 780 rigs in the United States. And then we're all the way down to 594. And let's take a look at the supply side on crude oil. And let's look at a real example. This is insight into our business. We're going to show you a little bit. We're going to offer at the end of this, if you want to join and sign up. We track the oil rigs by basin, and you can see we have been in a decline for some time, from 627 to 492 on the oil side. But what has that done to production? So we talked about shale oil decline, then new production. This is the net effect. You got to disregard these crazy points. This had to do with shut-ins that we had during the winter. We are back to a growth on shale oil in April, but not in May. So we have been in a declining to flat market, and the amount that we are producing per rig has stopped going up. So you combine that with the global market, but this is the reason that we look at these fundamentals is look at decline, look at new production, and then what the net change is. This is a net change of natural gas, and natural gas is a lot more in the decline. And we've gone from 105 BCF a day to 98, 99 in the past 5 months.
And a
So,
lot of that was based on price, but people, I mean, it really doesn't matter what it's based on. If the supply is going down, that means that things are going to happen in the market. So if you're looking at trading, you're trading this, you need to look at these as leading indicators. Okay. Now I realize it's not going to matter in the next 4 hours. You know, it's not going to have the impact in the next 4 hours, but overall, it's going to have an impact as you go along. And if you're more risk adverse, a lot of times you will trade the longer term commodity.
yes. A lot depends on time frame, which is kind of which is like what you said, $4. What did you say? $4.32.
That's right.
Let's mark that down. $4.32. I just put it in the comments. So there we go. We can remember that. Now that we understand a little bit of the supply picture and recognizing what variables to really watch, we need to watch this decline every month. We need to watch this new production every month. And I didn't add it on this slide, but we need to watch what the rigs are doing every single month. And you can see we have continued week after week just declining. I mean, we've dropped from 629 rigs in April to 594. So production will have a response, and we continue to believe that production will not respond. We are getting more efficient on how much production is coming out of each well. However, that efficiency is now waning. Then we flip sides. We take a look at the demand side. On the refining side, what are our inputs? On the natural gas side, what is happening on the electric demand, the industrial demand, residential commercial demand, LNG exports, Mexico exports, the pipeline distribution. And this is the reason that we put all of this into our interactive charts so that you could step through on a particular demand profile and decide what you believe is going to be the forward outlook for electricity. For example, this is information that has been reported, and there is a projection from the Energy Information Administration on their short-term energy outlook, and I don't believe it's high enough on electric. So any thoughts on demand before we move on?
Well, I think it's important that one of the biggest things that happen on demand is you hear people talk about inflation. So everybody says, well, inflation is going to have a chilling demand on crude oil. Well, it might have it on crude oil, but it doesn't change. You're not going to turn off your electricity because you have inflation. All it tells you in here is that maybe you're not going to, and when they talk about having an effect on crude oil, they're actually talking about diesel. And what they're talking about is being able to deliver goods to stores or to your home through Amazon. And if you don't order near as much, then they don't burn as much diesel. And that's where it all comes. That's the connection that you're looking at. And so when you start talking about demand, really it's how you operate your thermostat and how often you drive. That's the basic things that change the demand. Now, what's working on natural gas pretty hard is the LNG demand.
Right.
And that's going to be interesting. And that's based on Europe and Asian demand.
Yes. So the one of the last factors, or one of the other factors we look at is storage. And when we look at natural gas storage, many people look at this chart, which has kind of a 5-year band of what the high and the lows. So if you see the yellow line, that is the 5-year minimum for this time of year. But we have gone in the past month and a half or 2 months from 35% over the 5-year average down to 24, and I expect that number to shrink. And at the end of the withdrawal season, there was so many calls for running out of space on storage. We actually believe, and based on our models, that we're going to be at the 5-year average or below by the time October gets here. So on the natural gas side, you look at storage. On the crude side, many people look at just crude commercial stocks. We actually collapse everything into one metric, which is crude and products being distillates, motor gasoline, fuel oil. What am I missing, Bill?
Jet fuel.
Jet fuel. So when we get to the refined products side, we look at each one of these, the motor gasoline stocks, distillate stocks, and we put these all in this 5-year filter so that we can figure out exactly, do we have a lot in stocks, or do we have not that much? So the crude and products total stocks is one metric that tells us a lot about the refined products and the crude markets all in one chart. So that's what we publish every single day.
And realize when you look at the 5-year average too, folks, we're still including 2020. We hadn't quite got out of that mess yet.
No.
So it's still chasing us a little bit.
Well, and you have to consider some extraneous things that you may not think about. For instance, many people on, let me get back to crude stocks. Many people on the stocks side of the equation globally, if you look, we've kind of entered a new period. Let me clean this up. If you look just at the white line, we've entered this new period where we were hanging between 1.8 and 2.1 million million barrels down to this new range, which is around 1.6 and 1.8. But what has happened during this period? Do you recall, Bill?
Well, I think we've had a couple of wars, haven't we?
Couple wars, interest rates. Interest
Right.
rates, so the cost to carry those molecules has increased. So as that cost has increased, our base storage has dropped, and that is just a financial factor of the storage side. Then we look at market imbalances, and these are two charts that we actually look at every day, every week, and these help us understand how much we are importing, how much we are exporting, where our demand is. You can see exports to Mexico at 6.8, exports on LNG is 13.2. So you're at 20 BCF a day of exports, and we're importing 5.4. That puts a lot of reliance on that production number. And so the three variables that we consistently look at on the natural gas market are: what is the dry production? What are our exports to Mexico? What are LNG exports? Because, and then we layer in our base demand of electric generation, residential, commercial, industrial, all those demand factors. But that balance, that market imbalance is key. And what our exports are and imports. For example, on the crude oil side, we import, Bill talked you through the math. We produce 13.1 million barrels a day. We import 7, but we're exporting 4.5. You want to tell them why?
So in the United States, we have not built a new refinery it's getting to be almost 50 years now since we built the new refinery. We've upgraded them quite a bit.
I think there was a new one that came on, but it's not big.
Yeah. And so those refineries were built to actually refined Venezuelan oil, which is a heavy oil.
Mm-hmm.
The type of oil that we are producing right now in the United States, especially in the Permian where our big stuff's going, is very light, is lighter than that, and so they can't get the gas and diesel out using the processes they have in the current refineries. Now they've tweaked them quite a bit to where they can get some of it up, but the bottom line is it is cheaper to import the oil and export the light than it is to change the refineries. And so that's what we've been seeing going on, is that to get to the 16, we've got to import basically 6 or 7 million barrels a day to be able to get to that 16. That means that that 9 of our production is what's actually making it to our refineries. The rest goes out, and you have to realize that just about 600,000 to 750,000 barrels is condensate in that number, and so
Right.
that's the other little adjustment that you have to make for it. So that's how that balance works, and so we have to import oil in order to keep the refineries if they're going to run full, and that's all based on refinery margins.
Yep. Yep. So, comprehensive insights. What you do from here matters. If your business depends on the price of oil and gas or energy commodities, there's a few things that you should consider. And if you are a trader, there are a few things that you should consider. One is you can research various sources of information, such as the EIA, IEA, OPEC states like Texas, New Mexico, Oklahoma, Louisiana, West Virginia, Ohio, Pennsylvania, and so on. So there's multiple sources of data. There's Baker Hughes. There's all kinds of different data points that you can evaluate. This is a lengthy process, and I know because I used to spend 20 to 30 hours a week looking for that information so that I could trade effectively. So the other choice, so that's one choice, is you can research these various choices. Second choice is you can ignore and focus only on the technicals. And that's totally fine. There are a lot of successful traders that will be successful in the marketplace only focused on the technicals. But I will say, not many technical traders saw this move down or this move up. There were a few, but not many. So you could ignore and focus only on the technicals, or you could join us at Rogue Edge. And we're not the only option out there. There are other options, that not many that offer the comprehensive insight that you can get with our service. And we provide 3 levels of service. Rogue Edge at $89 a month, you get access to all the charts that we just talked through. Plus, you get a daily email, a weekly video recap, a weekly PDF that starts the week with kind of price points and what might be important that week. You get daily support and resistance. And all of this is only $89 a month, and it's delivered to your email and on our website. But if you have the need for a little bit more guidance and a little bit more insight, we do offer Rogue Premium, which gives you access to Bill and myself. We will set a custom strategy on our onboarding call with you, and we will help you identify that strategy that works for you. During the week, you're going to have access to our in-week video updates because we look at the market every day. Plus, you get access to our private Discord channels, a channel where we are identifying potential opportunities and what may be happening. This came from our community members. And then we look at particular price insights. So that is $179 a month. But if you need even more for your company, book a call with us and we'd be happy to talk to you. So,
And I tell you what, folks, that Discord channel is probably worth the whole value of Rogue Premium, because the insights you get there, the ability to talk to other people who are in the same situations as you. So, folks, what we're saying, if you need an edge, come go Rogue with us.
Well, bringing up that Discord, This is one of our recent testimonials, and Cash, if you're listening, thank you. But as an active trader, found it as a valuable resource. Bill and Brian and the community as a whole, as the advisors and second set of eyes and ears, investing successfully is really a team sport. So go to our website, take a look at some of our testimonials, make your choice. But when I look at it is you could spend a lot of time and find a lot of this information out there. Not all of it, but a lot of it. We try and provide it at such a value that if you spend more than an hour a month looking for information, you are actually wasting time and money. So we would love to have you, but hopefully this gives you a good insight into the key to understanding fundamentals, which is supply, demand, storage, market imbalances. Then you have exports versus imports. And that is a critical piece that the energy industry is in the United States is relatively new into. For example, on the crude oil side, on the demand side, on our products, total stocks, and our exports, our balance. We are currently exporting 4.5 million barrels a day. That was zero, 6, 7 years ago?
Yeah, not only was it zero, it was against the law.
Right. So, so that's and you got to look at various factors out there. So it was zero. Then on the natural gas side, we just walked through that on the demand side for Mexico and LNG, which are our exports. And we've grown from 3.5 BCF, which was primarily Mexico at the time. But in 2016, we were exporting 0.7 BCF a day. We're now up over, well, what was last week? 13.2. So that's what we want to bring to you is don't overlook the power and the impact of the fundamentals. Be sure to reach out to us if you have any questions. Bill, am I missing anything?
Well, as I always know that information is good, but information without insight doesn't help you. So come to us and let us help you get the information in an easy fashion and let us help you have some insight in how you want to trade and how you want to do that. Like I said, we are not trading advisors. We
Nope.
are not financial advisors, but
You look like a banker in this.
Yeah, you do look like a banker. So we've been in business for a very long time, and
Yes.
so we understand when there's a trend and when there's an anomaly, and so that's where our insight can help you because what we want you to be is a successful person.
Right. We want you to be a success, and we want to make sure
You're going the wrong way.
we want to help. We want to help guide. And honestly, that's part of the reason the Discord community is there. So listen, folks, thanks for tuning in. Really appreciate you. If you enjoyed this or like this, or enjoyed a piece of it, give us a like, drop us a comment down below. Let us know who you are, what you're interested in. We would love to hear from you. That's all we had this week. So we really wanted to say thank you for joining. We will be back next week. If you have a topic you want us to cover, let us know. This is a little bit more of an education than a market update this week. So let us know what you want to hear about. So that's all I got.
And for all you day traders, you just need to remember one thing.
There's no crying in baseball.
So listen, folks, thanks so much. We want you to be successful. Hopefully this helps, and we hope you have a fantastic day. Any parting words, Bill?
No, just you guys be safe and enjoy the summer and spend some time with your kids.
All right. Thanks so much, folks. Talk soon.